When China's economy slows down, the whole world feels it. From the price of copper in Chile to mortgage rates in the US, even the cost of your groceries, China's moves ripple through global markets. And with China being the world's second largest economy, the stakes couldn't be higher. Today, we're breaking down how China impacts the world economy in 4 key ways: trade, commodities, financial markets, and long-term structural risks. China's rise as the world's factory started in the 1980s, exploded in the 90s, and went into overdrive after joining the World Trade Organization in 2001. In 2024, China exported $3.5 trillion worth of goods, clothing, electronics, machinery, and in $2.6 trillion worth. That's why when Chinese consumers spend less or factories slow down, entire economies feel it. If Chinese construction cools, demand for steel and copper drops, and so do prices. That hits exporters in countries like Australia, Chile, and South Africa. Yes, companies have started diversifying to Vietnam, Mexico, and elsewhere since COVID lockdowns. But China is still the hub. If it slows, global trade slows. China is the world's largest consumer of key metals and energy: oil, copper, coal, soybeans, buying more than almost any other country. In 2023, it imported 11.3 million barrels of oil a day, the biggest oil buyer in the world. When that demand spikes, prices jump. When it falls, prices sink. Same story with metals. In 2024, China accounted for 60% of global copper consumption. If its property sector slows, like it has recently, iron ore and copper prices drop worldwide. That's good for easing inflation, but bad news for mining economies. Global investors watch China's economic data almost as closely as US inflation reports. When China's 2023 recovery fell short, the MSCI Emerging Markets Index fell over 6% in August alone. Many developing economies depend on Chinese demand, so when Beijing underperforms, their markets and currencies take a hit. China is also a major holder of US treasuries, over $750 billion worth. Selling even a portion could push US borrowing costs up, affecting mortgages, loans, and global capital flows. And while the Chinese yuan isn't fully global yet, its role in trade deals and central bank reserves is growing. If confidence in China drops, it can trigger capital outflows across Asia. Here is the long-term challenge. China's population is shrinking. In 2024, it fell for the 3rd year in a row, down 1.4 million people. That means fewer workers, fewer consumers, and lower long-term demand. Then there is the housing market. Evergrande's 2021 collapse exposed deep cracks in China's property sector, and that sector is a huge driver of growth. Put it together, and some investors are already looking past China toward India, Indonesia, Vietnam, and South Korea for the next big growth story. China's manufacturing power, its role in global trade, its commodity demand, and its influence in finance all make it a central piece of the world economy. But the next chapter won't be as predictable as the last. Slowing population growth, a cooling housing market, and geopolitical tensions could mean China's dominance fades, opening the door for other markets to rise. The question isn't whether China moves the world, it's how it's going to move it next. Thank you so much for watching. Let's build the bridges and not burn them. And goodbye.